Welcome to the AICPA Town Hall Series, your resource for the latest news and updates on pressing issues facing the accounting profession.
Good afternoon and welcome to the AICPA Town Hall. I'm Eric Auskerson, one of your hosts for today. We've got a great session planned for you. I'm here with Barry Melanson, the CEO. Great to be with you today.
Eric, great to be with you. And we sort of picked this date and we didn't know all these things were going to be happening to coincide with me being here. I feel like sort of I'm lucky.
Well, we're lucky to have you. And you're right, Barry. There's a lot going on. As everybody can see, there's a lot of papers in front of Barry and I here today. So we're gonna kick things off talking about the tax bill that passed the House last night. But first, let me just clear the agenda. So as you can see here, I think the slides are advancing. We're going to kick things off with a DC and profession update. We're then going to get into a deep dive again on beneficial ownership information, a clear hot topic. We're then going to cover some technical updates with Lisa Simpson. And then we're going to have a great discussion on some techniques on how to avoid burnout during the busy tax season. So Barry, let's kick things off right now and get into the discussion of what happened last night in Congress with this huge bipartisan effort in passing the tax bill. I mean, it was a 357. Here's a picture of 357 to 70 bipartisan vote. A picture of the chairman of the Ways and Means Committee, Jason Smith, out of Missouri. So, I mean, I think a lot of people, thought this was going to pass, but it did. And what's your thoughts just on this? And then we'll get into a little bit about the bill.
Well, it is a big vote. I think a big vote that sort of points to some other things that might be good signs. Maybe the most important from our listeners' perspective is that the ability to get a bipartisan vote like this might point to something positive as it relates to 2025 when we know, because there's a whole host of tax issues that are expiring at that point, that it's going to take a bipartisan effort to get those things renewed, adopted, or whatever the case may be. And at least we have one here. But we have to be cautious. It's just the House that has voted on it. We still have a Senate side. And that is not necessarily a clear version. There's also, from a good news perspective, some of the topics we've been talking about here, like Section 174 and all of those types of things are in it. From a retroactive perspective, we'll give some clarity on that. But at the same time, not everything we wanted is in it, which is sort of the typical thing when a piece of legislation passes.
So we'll get into what some of the key business provisions were in a minute. But when you look at this path forward, so right now, a lot of excitement over a passing last night, but at the same time, a lot of senators are commenting and saying, hold on, there's still a lot of work to be done, and I've got some concerns.
So this passage last night, I think you have to take in the context of the funding of government issue. So we have half the government has to be funded by the first week in March, the other half, including the IRS, by the second week in March. The House Speaker, the President, they do not want government shutdown. So that's all on the positive side of maybe something happening. The reality is that the House Speaker is committed to going through the normal process on appropriations, which means passing 12 different appropriations bills. There's not a lot of time to pass 12 appropriations bills between now and the beginning of March. The reason why that's important is because as we talk about the Senate and this tax bill, it could get hung up with the funding issues and things of that nature. It's probably, if the Senate passes a companion tax bill, it's probably going to be attached to one of the funding bills. So that becomes a very important part of the process. However, a 357 to 70 vote does send a pretty strong message that people want to see something happen. And frankly, as we've talked about on town halls in the past, we haven't seen anything like this in a long time. So we have to take that as good news as well.
Okay, well, thanks, Barry. And we've got Lisa Simpson with us. Lisa, it's great to see you.
Thank you.
So here are some of the key business provisions in the Wyden-Smith tax deal.
Yeah, so research in experimental, we've been talking about that for a long time. It goes back and restates it. That means that if you filed returns where you've had to use the amortization period because of qualified expenditures here, you have the opportunity to do amended tax return for your client and actually get some refunds back from that standpoint. Take the different approach, basically as if the ability to expense had never expired. The extension, now I would make just one point, it is extended for U.S. companies, not for international companies. And so that's just a really important part that's in there. And then bonus depreciation, also extended with a retroactive capability and some other technical amendments. But 179 also in there, which raises the cap based on an inflation perspective. Those are all business aspects that come into play. Lisa, you may have some other perspectives on some of the key ones.
We're already getting some comments about what should I be telling my clients? And as we look at some of the provisions that are retroactive, I think it's important to say that the deal isn't certain to pass into law. So we understand that any proposed legislation in the middle of tax season is going to be concerning, but we just need to let this play out a little bit and keep our eye on it. But these are provisions that most of your business clients are going to be really excited about.
Yeah, and just to add to that, I think we're always concerned about a tax bill passing in tax season or extenders being handled late. I think a fair assessment is this is a relatively narrow set of things that are in play. As Lisa said, the provisions that are in here where your client is affected are going to basically be positives in this situation. And I think a lot of it is going to entail either in the current year some different opportunities, like in the R&E or experimental area, but the other side of that is the amended stuff that got filed last year because we didn't have legislation. I think you can communicate it to your clients at a high level. This is a positive take. It hasn't actually passed yet, and I don't think there's any likelihood it's going to get through the Senate before March. Again, that's still in tax season. But I think the more immediate issue is the current tax returns. The prior tax returns, I think you can have the conversation with your client about dealing with that after the April 15th and other due date issues that are out there.
And Barry and Lisa, there's a lot of questions coming in on, how do I manage different situations with my clients? Should I file now with this amount of bonus depreciation? Will I have to amend? And then as you just mentioned, there is portion of this act is about 2022. As well. So there's going to be amendments required there. I think in the next town hall, we're looking to bring a couple of practitioners on it and to have a panel discussion and just have live discussion with them on how they're thinking about this now. Probably in 2 weeks, it still may not be final, but we'll probably have a better indication. And then as this, if it does become final, we'll continue to have those practical-based discussions.
Yeah, I think one practical answer, however, is I don't think if you're filing a 2023 return, this is just past the House. It is not law. Right. You can't, if you're under the gun to file a 2023 return, then I think it's difficult to take these provisions and you're sort of forcing yourself into an amended situation later if it passes. I think if it's something that is getting extended, you have to make a judgment call on how you're going to, sort of take that into consideration as relates to the amount that might need to be paid with an extension. But clearly you'll know whether this gets passed or not, probably by the, beginning of March. Mm-hmm. And then I think you can sort of take it into consideration from that standpoint. And as I said, the amended stuff from prior years, obviously, from a workflow perspective, I think, you're going to have that conversation. I think, though, it's a good opportunity to be able to, those clients, that are affected by these provisions, the expensing provisions and the R&E provisions, I think being able to make that conversation with them and explain where it is and that it's sort of halfway through the process, I think is a very a good message to keep them on the front end of what's really happening here.
And Lisa, there are some individual provisions that are being proposed, changes in the child tax credit if you have clients that might be impacted by that, the IRS has said, go ahead and file. We'll take care of anything retroactively. We'll fix any returns if legislation is passed retroactively. I personally don't think that I would go ahead and file. I would, give this another month and let it shake out a little bit and just be chatting with my individual clients that might be impacted by the child tax credit changes or any of these others. So.
Yeah, and what's really happening in that space, again, in this House bill is that it adjusts the $2,000 credit for inflation. It probably makes more lower income people eligible under certain qualifications with multiple children. So it phases in some activities. If you have people in that space, I'm with Lisa. I'd probably once it's passed, go the amended route rather than waiting for the sort of automatic process from the IRS. But that's just how I would do it. So I'm agreeing with Lisa.
Well, we've got questions coming in about the ERC, but before we get to that, Barry, maybe another point to share with the audience, and that's related to the SALT.
Right. So SALT, one of the big things in this process was what was going to happen with SALT. The $10,000 limitation on state and local taxes. There was some concern that this would not get through the House unscathed because it was not included, but it did get through. There is some discussion on the Senate side about passing a separate bill that might reinstate some SALT tax deductions. It's obviously very important for some states, but not sort of an outright or a very large one. I think what's being talked about is, doubling from $10,000 to $20,000 the deductible amount, but only for certain income levels, so not above certain higher income levels. I would be cautious of thinking that's going to happen. It certainly will be debated. It is a hot topic in Washington. I think the difficulty of getting that through is a pretty high hurdle. Although, if it comes through the Senate and it comes through in a funding bill, for instance, where this tax bill is also part of it, it might be difficult for the House to vote against it because of that provision, because of the SALT increase being in that bill. So it could get put in there. It is not in there today.
Thanks, Barry. So Lisa, moving on here, a lot of questions coming in about ERC. One question coming in is if this doesn't happen till March, is that going to impact this first point, the ending of the ERC program as of January 31st?
I think it is. Yeah. We've talked about the fact that this ERC shutdown is a huge component of the pay for this entire tax legislation. So, I think we have to assume that the data is out there. Will it be January 31? Will it be 2/29? I would try to go ahead and get them in if I still have some that need to be filed, because at this point, there's, it's out there, it's in the atmosphere, and it could happen at any day because it is such a huge component of the pay for on the legislation.
It's a fair question because today is February 1st.
Yeah. I think the likelihood is that it's going to be, let's just call it what it is. The January 31st date, the cutting off of ERC is an absolute, the cutting off of ERC is an absolute imperative to this bill passing. If that is pulled out in the Senate, if that's materially changed in the Senate, the bill will not have a pay for budget. People who are focused on the budget and financial implications of any kind of legislation moving, predominantly in the House, will in all likelihood, will switch their votes to be opposed when it comes back to the House. So I think you have to think about ERC and the cutoff of ERC, even though some people may not like it, even some people may not like the logic of it. The reality is that is the pay for. We all understand this notion of pay fors. It's not how we as CPAs would think about pay fors. In effect, they're saying, well, we were going to have to pay out a whole lot more than what we thought we were paying out on ERC. Now we're going to pay less because we're cutting it off. And somehow that produces a pay for, even though that excess amount of money that was going to be paid out in ERC really wasn't funded. But in Washington math, that sort of equates to a pay for. And I think there's a lot of consensus that without this as a pay for, the entire aspect of this bill has virtually no chance of passing.
And Barry, I think the questions are always asked. A lot of questions just are, here it is. Yesterday was January 31st, and they passed the bill in the House, but now it's going to be, you're going to be marching through February. So, and that's, do you keep filing? If the bill doesn't pass, then obviously the ERC program's still open, and then so those are very fair questions, and it's an interesting dilemma.
Well, as Lisa said, I think if you had something ready to go right now or shortly, and you could physically get it done, you're taking a shot that something might change. There's been a lot of cases where tax bills in the past, which had effective dates on things, that effective date has held solid. Once it was sort of communicated. This has been communicated for a couple of weeks. So you have history that points to that. There's also some history where, as the trade-offs occur in a tax bill, that dates do move. I would say, however, this is a much narrower piece of tax legislation than a typical piece of tax legislation. And so the likelihood of this moving is probably less. Now, there are some other ERC things that are tied to this that I think is important. And I know Lisa and her team have been getting a lot of questions on, and I would just like to address because I think it's important. First off, the original version of this bill had an extension to 6 years, the statute of limitations for the IRS to be able to go against ERC claims. The problem with that standing alone is that if a company lost its ERC claim, we understand that it has impact on the payroll deduction because the reduction on the payroll deduction is part of the calculation. The original version did not extend the ability to amend the payroll tax deduction beyond the normal 3 years. Our team did a great job in communicating that to the tax writing committee, and that now has in this version of the House bill is parallel. So if you have a client that loses ERC, they will have that same 6-year statute of limitation to amend their return for the payroll deduction that was, originally reduced when they filed the ERC claim. So that at least has a companion or a parallel point. The other side is we know we do have members that are concerned about the penalties and the enforcement against ERC filers or ERC preparers. Now, I really want to address this because we've talked about this on town halls many times when I was part of the town halls and many times when I wasn't. And the reality is that the profession was very frustrated about the so-called ERC mills that were producing claims, and a lot of CPAs were struggling with the validity of those claims, or clients that had gone to there after the CPA had said no, etc. So I'm going to start off with a macro comment. I think Congress, and they have said it, and the IRS, and they have said it, as recently as a meeting that our team had with high up officials, including the commissioner, they do not believe we are the profession is the problem in this space. They are very direct on that. They know, based on what we have put out, these town halls, which they know about as well, and the communications, and really the ethics and the approach that the CPA profession brings to the table, they know that this is not the target. The target is people who might not have approached that like the profession has. So there are provisions in this process that really allows people to be considered to be ERC promoters, which brings the ability for the IRS to go after those entities in both penalties and other sanctions. So let's just, what we think, and I'm going to cover them real quick, but what we think, these sort of tests eliminate virtually all of the CPA firms from being in the definition that's likely to be approached. First off, you're in the definition if you do contingency fees. Well, CPA firms aren't doing contingency fees on these original returns of ERC. Secondly, then there's a two-pronged test. One part of the test is if 50% of your gross receipts for the year are from ERC claims. I know some firms did a lot of ERC, but 50% of the gross receipts of a CPA firm is a highly unlikely test that a CPA firm is going to meet. Then there is a sort of a third notion, and that notion has two prongs, and you have to meet both of those prongs, and we think it, when I explain it, you'll see that very few firms, if any, will fall into that process. The first is that 20% of your gross receipts for the year are from ERC filing, services related to ERC filings, and the gross receipts exceed 500,000. There may well be firms that have gross receipts exceeding 500,000. By definition, almost, those firms are going to be such that their receipts for the firm as a whole is going to be hard to exceed that 20% test. So you have a contingency fee test. Basically, under our ethics, those fees that firms were not approaching it that way. A 50% of gross receipts test, 50% of a firm's total fees from ERC, highly unlikely. And then the third test is 20% of gross receipts, and the gross receipts exceed 500,000. So you might meet one of those. You might meet 20%, or you might meet the 500,000, but it's still going to be pretty rare that a firm would meet both of those tests. So it is a provision in there, and I think, frankly, based on feedback on town halls and others, people had a lot of concern about these ERC tax mills, and the Congress is trying to address that point. And I think by these tests, pretty much is saying that it's not a CPA firm issue.
It's not a CPA firm issue. The CPA firms are doing high quality work. We've talked about PPP, ERC, even tax returns. I mean, the government is always, doing their reviews of these government-based programs. The interesting thing about both PPP and ERC, these are, self affirmations. You're stating you were shut down and things like that. So they're reviewing those documents. And even if a firm did meet one of these tests, they probably did good work. And
that's an important part. So let's say
issues.
Someone out there meets one of those tests.
That's right.
And you're technically in the definition of a promoter.
Yeah.
The actual penalty nomenclature is related to the due diligence aspect.
That's right.
So it's it's a penalty under the notion of aiding and abetting the understatement of tax, basically. Right. And the defense against that is the due diligence that you would have exercised to reach the conclusion that you did. Again, from an ethical perspective and how CPAs approach their tax practice, due diligence is a pretty common part of what people do in these particular environments. So even if you I'm going to say, fail one of those tests and you get put into the definition, the defense is due diligence. And due diligence is sort of a very important aspect of what CPAs do.
Well, Barry, thank you. Thanks for that overview. We're going to now move to, and we appreciate all the questions on ERC, so thank you. Thanks for that input. We're now going to move to beneficial ownership information. So, Lisa, I think you're going to, cover it at a high level again. Then we're going to get into some, pretty, important news from CNA.
Thank you. And I always like to cover, just to try to level set for those of you who may be new to Town Hall and who aren't familiar with beneficial ownership information reporting requirement that came into effect January 1, 2024. We've got some of the key tenets of the reporting requirement on the slide for you. Basically, this is anti-money laundering reporting requirement regulated through FinCEN, the Financial Crimes Enforcement Network, which is part of the Treasury. And what we always like to talk about is that existing companies have until the end of 2024 to file their initial report. So I say that because that's important as we talk about how resources are being developed, how clarity is coming into view around what the form looks like and what some of the tools are going to be. So I do just want to point out that the FinCEN Small Entity Compliance Guide is really very helpful. Their FAQs are very helpful. They're going to address a lot of the common questions that we get. And then we have a ton of resources in our BOI Resource Center to back that up. I always like to point out the latest podcast that we have on the topic because it's really going to answer a lot of your basic questions. And then just this week, some news came out about a daily filing penalty increase. So I've given you a Journal of Accountancy link as well. But what we really want to talk about today is a statement that the AICPA's Member Insurance Program underwriter, CNA, provided to their policyholders yesterday. And, we've had a lot of conversations on town halls for the last several months about your concerns that perhaps this type of service wouldn't be covered under your professional liability insurance. And, Barry, we're happy to say that CNA has really taken a strong position, and we're glad to bring that to you. Apparently, I gave you a wrong link on the slide. My bad. So you should be able to get the new link. It's being pushed out to everyone in the audience today, to our 10,000 people in the audience. So grab that link, and you can download that CNA statement about coverage. And Barry, this is something you and I have spent a lot of time talking about. So I'll get your thoughts.
Well, first off, Lisa, that's correct. We did, and you personally did as well. And so thank you for your outstanding work in this area. Let me just sort of simplify it for everybody in this process. Look, it's an individual decision of whether or not you want to do work in this area for your clients. It is a compliance element. Our position is we wanted it to be clear that from a liability perspective or a professional liability insurance perspective, that if you choose to do so, that is a component part of what a CPA practice might look like, and it should be covered. And the Q&A, the frequently asked questions that have been addressed, we think address that very effectively. And our team had a lot of work with CNA to get to this point. We know that the issue of concern has been in the unauthorized practice of law area if this is deemed to be unauthorized practice of law. So no state, as we sit here, has said this is an unauthorized practice of law. And, there's, I think, pretty strong evidence that that's probably not going to be an outcome, but it could. So what this Q&A says in very simple terms is that doing work in the beneficial ownership area is included in the definition of accounting services in our policy that 25,000 firms in this country have. So this is not about other insurance companies, but this is about the insurance policy that our 25,000 member firms that use this program. And it is in the definition of accounting services, meaning it is covered. The second part, which we were very concerned about, what about the retroactivity issue? We just spent time talking about retroactivity on the tax law, but we don't want retroactivity in this provision. In other words, we want it to be that if there is some future determination of unauthorized practice of law, the work you previously did before that determination would be clearly covered. Now, if there is an unauthorized practice of law determination, future work is a different fact pattern, and you would have to be diligent in not doing the work at that point if there was ever that determination. But we wanted it clear that if you did work in 2024, and then let's just say in 2026, some state says, oh, this is an unauthorized practice of law, you are still covered in that environment of the work that you did prior to the unauthorized practice of law determination. And the frequently asked questions addresses that point and makes it clear. Now, let me just make this other point. When you read it, there is provision that you'll see that it says they want to be clear that fines and penalties are not covered from a professional liability insurance standpoint. That is not new as it relates to FinCEN and BOI. That is always the case. So there's nothing different there. That is always the case. And I think the Q&A gets to very strong clarity in that particular environment as well. So from our standpoint, we think these Q&As really put each individual practitioner in a position. If you want to do this service, you ought to have the confidence to be able to do this service if you're covered under our policies. And, obviously, if things change with unauthorized practice of law, we're going to be active in that, working with the state society in whatever state that may be. But that is not the fact today. And so this makes it clear that these activities fall. And one last point, it also talks about defense costs, particularly in civil litigation, and the way civil litigation typically works. And it makes it clear it would be an extraordinarily unusual fact pattern where you would have a unique type of case where there might be a question, but in the normal course of things, defense costs would be part of the policy.
Yeah.
Well, thanks, Barry. Lisa, if you go ahead.
I just want to give a real quick update because we know that if a firm decides that they want to provide these services, then what? And one of the first things should be, then I need an engagement letter. And we are working very diligently with Aon and CNA to provide you a templated engagement letter that will be available to all AICPA members. And that should be out within the next few weeks. So we've absolutely got that on our radar. And we're also working on some resources that can help clarify from our perspective, what's a compliance function, and then where potentially you need to tell a client, this one you're going to need to determine who your beneficial owners are yourselves, or you're going to need to go get legal counsel. And more to come.
More to come, Lisa. And what we have here, you and I talked about this in the last town hall, the BOI landscape. You've got training that you'll have to, go through if this is a service you're going to have to offer, the engagement letter. Solutions, we are talking to a number of solution providers. This is a space that clearly will be supported by technology. And we were with a solution provider, and they let us know all these solution providers are connecting their platforms into FinCEN. And FinCEN, the first few weeks, received about 100,000 applications related to this new requirement. So this is something that's going to continue to evolve, and these solution providers will clearly help firms understand how to provide this service. I know some top 100 firms that are looking to provide this type of business filing service, Barry. So this is something that we just got a comment from somebody, one of the attendees, saying, in some ways this isn't a lot different than the compliance related to taxes. So maybe as this all evolves this year, firms will start strategically thinking about how they can support their clients with these filing services. And it is complex to get all these filings in to FinCEN, or actually all the different Secretary of State. So this is something, if you're interested in building out this area, there will be training, there will be solutions, and there's going to be more and more guidance. And it's great to see, the support of the professional liability carrier and CNA and Aon.
Yeah, it's very important that we got that support, and we're happy we got that support. And it just gives the option, really, to the practitioners as to where they want to take their practice and the relationship with their clients.
So, Lisa, we're kind of at time. We've had a busy first half of the town hall and still a lot more to cover. So I'll let you take us through this technical update section.
Thank you. I'm going to do the technical updates fairly quickly because we have Alex Dorr that I could spend hours and hours talking with. So really quickly, as a reminder, if you try to click on the link to the CNA statement that talks about BOI, that link's not going to work, but our team behind the scenes has pushed that out to you through the On24 platform. So you should be able to grab it there. And again, my apologies on that. Let's talk about ERC again. Even though we spent a lot of time talking about it in the beginning, I just want to make sure that in every town hall, I also talk about the voluntary disclosure program, because it has such a limited time frame for practitioners to work with their clients to determine whether or not they want to take advantage of that program. As a reminder, that is if an entity claimed and received their ERC, but is now having second thoughts about whether or not they were eligible, they can apply online through this disclosure program, and they can repay the claim at 80% with no underpayment on interest or civil penalties. There, I've given you a link to the form there, and it is an option to consider. So basically, when you're thinking about ERC and whether or not a client took ERC and maybe wasn't eligible, didn't meet the requirements, there are three options. You can withdraw the claim through the program that we've talked about previously. You can participate in this new voluntary disclosure program that was announced in December, or you can amend the 941 Acts. It's complicated, and it's probably a client-by-client decision. So the AICPA tax section has developed a decision tree to try to help you think about the different decision points along these three options. They've made that available to all of you in today's resources. Make sure you grab that. I've looked at it. I think it's very helpful, and it's going to give you some good direction. Again, it's client by client. I know we've got concerns about, should you amend the tax return if a client had an ERC provider file the ERC claim and you want to know what your role is. So we've given you a link to some of the Office of Professional Responsibility guidance that came out about a year ago around that as well. But again, please grab that decision tree because I think it's going to be a good resource for you. And also, there's a Journal of Accountancy article that talks about the auditor's aspects of looking at ERC. There's an invisible link there that when you download the slides, you'll be able to click on it and go to the Journal of Accountancy for a really good conversation about auditor implications around ERC claims. So we've got our ERC covered, we've got BOI covered. Now let's talk about another fun topic, which is digital assets. The IRS has continued to expand the number of forms for which they're asking, at any time during the year, did the taxpayer have digital asset transactions? Last year it was mainly around individual returns. Now they've expanded that question to estates and trusts, partnerships, S-corps, and regular corporations. So I've given you a link to an IRS news release and a JFA article that will bring you up to speed on that. Our advocacy team continues to strongly push the IRS to give us definitions around these types of questions. So we continue to push from an advocacy standpoint for some clarity, and be on the lookout for a Tax Section Odyssey podcast that is going to talk about digital asset reporting as well. And then the last important topic that I wanted to talk with you about today is around revised guidance from the Department of Labor on steps to determine whether a person is an employee or an independent contractor. I know that when I was in public accounting and then when I was running a small business, this was always something that you had to think about. And in just back in January, the DOL came out with a new regulation that goes into effect March 11, so just about 6 weeks away or so, and it's redefining what the factors are that you consider if you're looking at whether a person that you've brought in on a contract basis is really a contractor or should they be classified as an independent or as an employee. This has big implications if you don't classify workers correctly. And you all know this as you're talking with your small business clients, you know that there are payroll tax implications, unemployment tax implications, and that those can really add up if there were to be a determination that you classified employees incorrectly. So we've given you the 6 new factors and some other great resources that I want to point you to take a look at, because as you're talking with your business clients or any of your clients, this is going to be something that they need to be thinking about and have on their radar as well. The Small Entity Compliance Guide is very helpful from the Department of Labor. It gives some good information. And we have a great podcast that I've just listened to a couple of days ago that walks through each of these new economic reality factors and gives you some things to consider about how they might apply in a particular situation. And then as always, I love to give you a link to the Journal of Accountancy for additional insights. It's a big topic, and I think it's one that we all need to have on our radar as we're talking with clients. Have to put in a plug for a lot of tax section resources. Some of these are open to all, some are limited to tax section members, but some really good information. I posted the Journal of Accountancy quick filing guide on Twitter and just got a huge response. So I think that's a really popular resource. If you did not check that out, grab the link from the slides once you get those downloaded, because it is super helpful just putting all the data points in one spot.
Well, Lisa, thank you very much. And now I know I and Barry are looking forward to this discussion with Alex Dorr. The title here is Avoiding Burnout During Busy Season, but a lot of these techniques you could leverage no matter what you're doing in business. And Alex Dorr, bring Alex on up. He's been on a few town halls with us. He was at Engage with us, and he's part of the reality-based leadership group. And they really provide fantastic insights on how to lead and really how to, sometimes take drama out of the business or stress out of the business. So welcome, Alex. It's great to have you here with us.
Thanks for having me back. It's an honor as always.
So I'll let you kick things off here. This is a high level map of what you're going to be covering with us today.
Yeah, it's great to be back. And the team reached out and said, just what are some ways right at this time for, quick decision making, ways to avoid burnout, energy management. And that's kind of the name of the game. I know it's busy season. We got a ton to do, and that's going to be there. But I wanted to come up with my quickest techniques to help all of us, whether you're leading teams, whether it's just with your colleagues, with your clients, to conserve energy that might be lost to drama and instead put that into whatever needs to be done. And some of you, I was worried, it's like 10,000 of us on here, like, just give me the tax information. What do we got coaching and leadership coming in here for? But I think these might, in a way, help make sure we're able to sort out some of these challenges and stay in there for our clients without burning so much energy. So the three things I want to hit is some quick decision-making techniques and tools, this idea of the toggle switch, and I'll get into that in a second, and these mindsets and how to conserve energy away from what I call low self and high self. And so let's get into that. If we can go to the next slide, I'll set the stage, and I want to link it to burnout. And we do a ton of work. I'm in healthcare a lot. I've been doing a ton of work with accountants in different firms of all sizes. And this idea of burnout, I find when people are getting to that feeling, or they're starting to get the sense or the early stages of burnout, I'm fascinated by where people put their energy, where the conversation goes, and how their workday goes. And as they go through their day, we got what we plan to do. And if we're in the zone, and even though we got a lot to do, we're knocking things out, our teams are really operating on all cylinders, that's good stuff. Where we come in with our content is when you're facing what I call a unpreferred reality. And I know with all the stuff going on and the ambiguity, there's a lot of unpreferred realities going on right now, some information we wish we had. But you're going through your day and all of a sudden you're hit with an unpreferred reality or a disruption or something didn't get done or a client's not doing what you asked them to do or we missed something. Most people, when they're facing an unpreferred reality, they get into two areas of behavior or thinking that leads to no results and a ton of extra energy loss that leads to burnout. So the first thing they do is they argue with the said unpreferred reality. So they're like, ain't it awful? How the heck did this happen? This is a disaster. Who thought of this? If I could make some of these policy decisions, I would do X, Y, and Z. Basically, if I ran the world or the firm, this is what would have happened. So they get spinning there. Once that gets really tiring, which it always does, they then jump ahead, if the team can put up the whole model here, to the far right side. They start to wish for this different future that would take, and then they take no action. Up until the point they even wish they picked a different profession because this is too hard, too busy, too complex. Nobody knows what they're doing. So they start to wish for a different future where they had different colleagues, clients that actually listened. We had more time, but and then they get frozen. They take no action. So in between these two areas, there's this tiny space, and I call it the opportunity to add value, the place for leadership, where we want to live as much as we can every single day, but definitely during challenging times like busy season. And this is the opportunity to take that next right action, to add value, to step into that space where no one's occupying because everybody's complaining about the two outside spaces, and take the next step forward. And if you and your teams or those you work with, or you can even channel your client conversation and focus to this place, this is where everyone has extra energy. We're not burning extra calories on things we can't control, and we're able to take just the next right action. And it takes a few techniques to be able to focus the energy there. And that's what I came up with, where in the next slide, we're going to talk about some key quick techniques that can help us live there as much as we can. So by the end of the busy season, when you go down swinging, you spent the most amount of time in the place that adds value. And that's where you have a lot of hope. Things seem possible. People are doing a lot, but they still are connected to what you're trying to do, and they're engaged. And so when this isn't happening, I want to just build on it a bit and talk about that toggle switch. Everyone on their forehead has an invisible light switch. Your clients have it, your colleagues have it, you have it as well. When we're focused on those two outside spaces and we're really feeling like suffering and burnout coming, we're usually in what I call low self. We're toggled down. And this is where you're at a place in your mind where everything seems too complex. Nothing's working well. We have way too much on our plate. This is way too much expectations. I can't fix everything. So how can I fix anything? I can't fix our systems that should have been figured out. I can't fix my clients. I can't fix, my teams right now. So how can I impact anything? So my only options to disengage or go through the motions or just basically like blow up and get overwhelmed. And then that's where we get into fight, flight, or freeze in our mindset. And none of us do our best work, or we're not at the highest level of our certifications or our professional demeanor when we're in low self. And this is where you see some common behaviors. You feel the stress, you're in low self, you feel it in your neck, your chest. This is your indicator that you're in low self. And this is where people get into a lot of behaviors like gossiping, tattling, venting, ruminating on the call. As I work with more accountants, numbers-minded people, engineers, we don't really vent out loud like some other professions where we do a lot of gossiping, but we do a lot of ruminating as our clients talking. We're like listening, but in our heads, we're like, oh my gosh, what is going on? They don't get it. And that's low self stuff that just drains us. And in the same moment, the same person can toggle up into what I call high self. And you got to catch yourself in low self, and then you toggle up into high self. This is where you have access to a completely different part of your brain. This is where you can take complex situations with a lot of ambiguity and come together with your teams. You're naturally more collaborative. You're naturally innovative. You're open to the unknown, and you're able to step forward in that mess confidently with all of your training. You're less judgmental. You're more creative and you're open-minded. But the key is you can't be in low self and high self at the same time. And what I find is so many people spend like 90% of their day doing the work, but in low self in their mindset. It's like, I'll do the work, but the whole time I'm like, I shouldn't have to. This is absolutely ridiculous. It should be done. Someone should do it. Why aren't people more capable? And that's where that energy really starts to drain. And so this is a really powerful reminder that keeps it simple. Like, are we approaching each client interaction in high self? Was that meeting a high self meeting? Are we toggled up as we enter into this conversation and try and figure out what's the next right action for this client? And in the next slide, I want to give you some ways to.
Now, I'm going to go to the next slide for you, but I'll just jump in and let you know that a lot of the audience is saying unpreferred reality, BOI, tax legislation, hope for future. They got some ideas there. So
I didn't know where you guys were going with
Wait.
that, but I was cracking up as it was going. I'm like, wow, this is great language for your clients. And we'll get into that next, but I'm glad you saw some comments coming in. So the first things, a lot of our techniques, people get really fired up because it feels like you can just whack-a-mole drama with it. Where drama comes up, accountants ask me like, what's the one technique I can do so I just can get rid of it so I can get back to doing what I need to do? And that's a little too simplified because we have humans involved. And I know many of you are thinking, well, this would be so dang easy if we just didn't have humans involved. But our clients, a lot of times are involved and they're humans. So you got to do this first step that many of us can forget, myself included, as supposedly the second best expert at reality-based leadership in the world, only to our founder. You got to remember to validate the experience before going into one of these techniques I'm about to give you. So if someone comes in and they're just like, oh my gosh, I'm just so annoyed by why this isn't, figured out yet and why you can't give me a straight answer. So what I do is I validate that experience. I go, I see that this could be really frustrating. In fact, sometimes I'm annoyed when I don't have all the information I need and it doesn't seem as clear as I'd like. Validating that experience is the first step to just connect. You can see that someone's frustrated. Even if you're not as frustrated, you can see why they're frustrated. And that's the first step to give you some access to this helpful technique. And so when someone shares with me that if they're venting or they're, a lot of the group here likes when I say BMW driving, we call that bitching, moaning, and whining. You guys can steal that as well. And so that's what people do when the going gets tough and then they face an unpreferred reality. They step down and they BMW drive about it. And how do you know that someone just stepped down on your team and they're not finding that space to add value? They usually BMW drive about it. And so I just validate and I say, I see that you're really frustrated, angry with this. I get upset when this happens too. And now if you could, team, jump into some of these techniques. Here's the juice I wanted to give you. I just master a few simple reframes. And what I love to use with my colleagues, clients, even my own mental processes, is I love to use given that right now. I go, yep, I validate this as a very unpreferred reality. Now, given some of these constraints and some of these risks that we need to mitigate, what's the first thing we could do to help? Here's the first thing we might do to move forward for now. And so I love giving that whenever someone comes to me on my team with an excuse, a constraint, oh, you won't believe what they're asking us to do now. I go, ooh, I see that way. That's frustrating. Given these two new constraints and given that our goal, what's the ideal future, the hope for future, is to hit this deadline, what's the next thing you could do to help right now, short term? And so I just channel that energy. I recognize the unpreferred reality. I take a glance at what we're trying to create here, what we're trying to do for our clients, make sure we're compliant, make sure we hit the deadline. What's the next thing you could do to help? And it's a way to just wrap up all of that drama and say, I see you. I see it with you. It's fair. And given that, what's our goal and how can we move forward? And the more times you do this, it really just conserves that energy and keeps us moving forward. That makes sure we're not losing any of this as we do all this busy work. The second one I like is, I call it come close in. You'll have people come up to you and say, okay, if you get out ahead of this, if you think about this is what they're saying now, but once we get into March and then you add on what's happening in April, and I got my 3 kids all in basketball and I got to go to all these games and I'm supposed to work extra hours. If you get all the way into April, this is all going to just collapse and it's all going to heck in a handbasket. And I'm just like, oh, let's come close in. How are you doing today? Like, do you have all the information you need to communicate with your client in the next 10 minutes for that meeting? Most people are like, oh yeah, I'm good. Actually, things are good for that meeting. What about the one this afternoon? You feeling good on that? Yeah, that's good. So I just keep expanding. I came close and now I'm expanding until we run into a little bit of anxiety. What about tomorrow? Funny enough, we're good. End of the week, weirdly enough, for the first time ever this time of year, we're good. What about the end of the month? Oh, well, that's where it's all a disaster. We got these new deadlines. I go, now we just found the place. We got to ask for some help. We got to get tapped into the AICPA resources. We got to reach out to some other experts, clients that, are partners. And that's how you can bring people back to the present moment, come close in, work with that anxiety, and just make sure people are taking it in strides in that way. And by the way, we all have the human condition. We'll screw this up and only daily, but that's what I land in each and every day. Was there a question that came in?
It's just me. I just wanted to resonate because I've been using that coming close technique personally, because I find that, there's been a lot going on with BOI. There's been a lot going on with possible retroactive tax changes. And so I'm using that coming close technique and just trying to stay focused on what's next. And I'm finding that really helpful. But you've got some other specific tools that I think we wanted to get through too. And then we've got some links that our audience can dig into to get more information, because we're getting a lot of questions about, I need more.
Love it.
So let's talk about the SBAR.
We got 2 more there. I love although not ideal. And yep, this is unpreferred reality. Given that, let's move forward. But the best one right now, this one's more of actually like a template that can scale clear communication and quick problem solving. It can be verbal, but I like people to write this before they come to you. So if you're someone this time of year that gets pulled into every single question and you're like a slot machine because you have a lot of knowledge, but your junior associates are not bringing their best selves forward, or they're very hesitant, or they're just not giving you enough, and then you answer it, use the SBAR. So someone says, hey, do you have a minute? I got a question. I go, I do. I'm always here for you, but do you have your SBAR? They're like, what's an SBAR? Real quick, I'll teach it to you. And I want it every single time you come to me until April 15th or longer. What's the situation? You're bringing this up. It's got to be 1 sentence. Now, it's hard to get into all the drama when you have to get clear on here's the main issue. And now you can come with 3 SBARs for 3 different clients or 3 different situations, but I need you to go through these. Now, what's the relevant background? So why are you bringing this? What does this to do with strategy, background of this client, our goals, some new legislation that's out there, whatever it is. Now I need your analysis, not your opinions. I need your expertise, not your opinions. Expertise is the data, the policy, what we've done in the past, best practice. What's AICPA saying to do here? Not opinions, which are gut feelings. This would be cool. We need true data, policy, all of that stuff. What's our system allow? Things like that. And then I want your recommendations plural. You don't have to have an answer. I want your ideas on how to move this forward. I want to hear from you and the cost benefit for each one. And then as the person that you come to, all I have to do is check that template for drama. And a lot of times I just go, great job, Lisa, number 3. You know what you're doing. Go with that. Can I count on you? And now you run with it. So he or she who processes the work takes action on it. So they're in their lane. You're still in your lane doing your work, not theirs. and everyone feels empowered. And
Yeah.
so this tool can also be flipped where your teams, to make sure they're adding value, they can bring their SBARs to the conversation. It gets everyone into right action, problem solving, ditching the drama. And we got a video for you to make it simple.
Yeah,
and
absolutely. And as we were talking about this, I view this SBAR approach as a way for people to add real value and show leadership, especially at this time of year where, you know, it's high pressure, it's fast decision making. So this is a really good tool for people within the firm to be using to help develop their leadership skills and their thought processes and add value. So we've got a lot of resources that you can tap into to learn more about Alex, and he's worked with PCPS to give you some templates that we've tweaked a little bit to be even more aligned to the accounting profession. So Alex, we've got a ton of praise for you, and I know that we had to push that just a little bit because we had so much technical stuff to talk about, but thank you again for sharing your approaches, and I love the concrete tools that you bring to the conversations to help us toggle up and think a little more at a higher level. So thank you for that.
You're welcome. You're welcome. I hope it's helpful.
Yeah, thanks, Alex. Thanks, Lisa. So, but Barrett, we are kind of in the closing session here. Barry, I know you listening to all this, and you've been engaged with Alex over the past, year or so. What's your thoughts here with BOI and tax season, quickly as you hear some of these techniques?
Well, I mean, it's a frustrating point because you got a tax bill and tax season. No one ever wants that. I can tell you our team has the frustrations on that as well. Some of the frustrations that Alex talks about, because frankly, we would all like government to operate in a more rational way, but it's not a rational process right now, and we end up with what we have. I know some of the questions were like, for instance, well, it makes it worse because research and experimental is retroactive and 179 is retroactive, but in town halls over the last year, people wanted those things, right? So it's in a perfect world, we could see that being done in a more rational time frame for the profession. Unfortunately, Congress doesn't operate on just the profession, and that is unfortunate, but that is the fact pattern. The other question I think that's in there is the BOI. You asked me a question on that. The question is, well, why do we have BOI, or why wouldn't we just be advocating to do away with BOI? I think you have to understand the larger context here. The world we live in today has a lot of money laundering, and the G20 countries, the B20 countries, which is the next, so the top 40 countries have all come together to try to do things to minimize, you can't eliminate, money laundering activities. Throughout the world, our profession is on the front lines of those types of activities. And the expectation is the profession has a role in that space. And, I think from an ethical standpoint, we would all agree that, money laundering is not something that we condone. We have advocated for, as people have acknowledged, a delay. We actually are advocating behind the scenes to have the form and the information and the triggering events to be more rationalized, like what's deemed to be a change. We think there's a lot of improvement that can be made. But I think it's a global effort of, world leaders to try to I don't know, corral maybe is the right word, some of the money laundering activities, and a digital world provides capabilities of trying to do that.
Well, Barry, we've talked a lot about the public-private partnership. I mean, back, with the CARES Act, the PPP program, government did what they tried to help clearly during the shutdown, during the pandemic, and the program's here. I mean, they try to have good intentions, be it BOI, be it the new tax legislation, just to help drive things forward, and they rely a lot on the trusted advisors in the firms.
They rely on the trusted advisors, and I think we should rely on government to act in a normal fashion as well. Right. I think it goes both ways. But as our team, Mark Peterson and others have said in prior town halls, what's called regular order has not been the order of the day for Congress for many, many, many years now. And, it's going to take all of citizens to expect regular order from their government if we're going to have some rational activity from that standpoint.
Well, let's bring the slides back up. Barry, it's been great having you here in New York. Always great to have you, Lisa. Great to have Alex as well. On the next town hall, we're going to have Mark Peterson, and we can have Mark talk a little bit about some of the advocacy, because even though we say it's a public-private partnership, there is advocacy, a lot of advocacy that the AICPA is doing on every one of these items. We're going to have Aaron Collins from the IRS, which is going to be great. And Melanie Lauritsen will be engaging with her. And then we're going to have a past chair, Kimberly Ellis-Taylor, with us. So, Barry, great to have you with us. Lisa, good to have you with us as well. Thanks for all of you tuning in. Hopefully these technical insights were helpful, as well as this closing session on just some leadership techniques. Thanks for being with us today.
Thank you for your participation. You can now subscribe to the AICPA Town Hall series on your favorite podcast platform, as well as watch archives on YouTube and AICPA TV. Tune in for live broadcasts Thursdays at 3 p.m. Eastern Time.